What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is August 15th of 2022. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, we got to ask a big question. What the heck is going on with Bitcoin? For the past month, nearly the past month, we have been at this chopping range around $24,000 to $25,000. And I want to try to get to the bottom of what's really going on here, as Bitcoin has rallied quite steadily off of its market lows over the past few months. So in today's Macro Monday special, we're going to be diving into what Bitcoin's doing, talking about Ethereum, why we think we're ready for a cool down, equities entering into the later stage of their rally, why it's not the time to take excessive risk, and the big topic to close off, the 5 charts you need to be watching to know where Bitcoin, Ethereum, and the stock market are really heading, that are going to give us all the pre-hints we need in order to understand where price is going to head. All right, let's go ahead and dive into it, guys. First off, I want to go ahead and talk a little bit about Bitcoin here. Now, you all know here on CoinPanel, you guys can track my TA real time, and it's what we're watching for in the market. And as we can see here, we've been generally talking about one of two scenarios here. We are in a contestment period. This is not a period of price to get absolutely certain of anything until we get further confirmation. And right now we are still in this sideways channel, albeit likely leaning in favor of the bears here. Now, the reason why is because of the fact that we've had multiple attempts over the past few months, as far back here, really as late June, the past few weeks, where we've been trying to get above here each and every time, trying to push price above this key line of resistance on this generally ascending wedge. Now, as you all probably already know, in TA 101, an ascending wedge is usually bearish here. So that's just one thing to consider. It's not a guarantee of anything, but overall, the signaling of the rapidly expanding higher lows but consistent resistance showcases essentially that there are sellers who are taking advantage of the market order flow that comes in at these ranges, the FOMO that people have trying to buy into a potential breakout like we've got here marked in the green. But instead, it's getting weighed down every time. Now, Bookmap is going to give us all the answers we need here to this topic. Why is it important to be looking at Bookmap? This is another one of our tools we use here on the channel, one of our partners. And they explain here, not just through market price action, but through market order flow and the heat map, or basically the change of the order book over time in accordance to price as time progresses forward. We can see here exactly what's going on here. We've got market order flow starting to grow weaker here over the past few days. We're taking a look from August 12th to where we are right now in the morning of August 15th. And what's really telling here is that you've essentially got each and every time prices coming up here, you've got market order flow absorbing some of these ask orders. Okay, so these are investors who are already holding Bitcoin, who are looking to sell at around $25,000. And you can see here through the volume dots, we've got buyers pushing up price here, absorbing that liquidity, buying up that Bitcoin, but not having the follow through to be able to carry price higher here. Once that liquidity or that Bitcoin has been bought, afterwards there's not enough market order flow. It starts to teeter here afterwards and leave price dragging lower. Now, what we can also see here again is yet another run up getting absorbed, all that Bitcoin, right? There's people providing that Bitcoin to whoever wants to buy it at that range. So there's someone who's got a lot of BTC who wants to sell at that range. And it's enough to prevent any market order flow of what we've got in the market, people just market buying Bitcoin, from being able to carry prices higher. And that has happened time and time again. And now it's starting to showcase that not only do we have weak market order flow here, actually negative here for the past few days, but on top of that as well, that the only buyers that are really coming in here are those providing bids. And we can see as we moved throughout time, there are people who are setting these bids. They've gotten filled here. Institutions, serious buyers are not coming in and market order buying at this range. They're not taking the risk. They're going to make sure that they don't incur dramatic slippage, and they're waiting for lower prices. And this is exactly how institutions trade these kind of markets, because they know that this is likely still very well a bear market. It is not a bull market here. And we have not gotten the confirmation we need in order for things to move dramatically higher. Now, I want to go ahead and provide a really interesting perspective here. We're taking a look at the 4-hour time frame here, but there's something different about this chart here that I want to focus on. Notice our 2 moving averages here, right? This is the 200 MA and the 200 EMA, right? Identified by their colors. The MA is blue, the EMA is orange. Now, what's different rather than what we usually look at. We usually look at the 4-hour time frame for these moving averages. And while I do want to take a look at that for sure, as we will probably do in the next video, what I want to focus on today is actually a much bigger time frame. And the longer term the time frame, especially when price is near it, the more valuable it is. And a really cool feature that you have on TradingView is the ability to be able to turn these moving averages to lock into a certain time frame. So if we go, for example, to the daily chart, right? These are our moving averages here, right? Our weekly moving averages. So I'll take it here to the weekly. You can see that they're correlating around two key price ranges, around 23K and around 25K in price. Now what's really cool is now we can go into the hourly time frame or the 4-hour time frame, and we can print those same values here on a shorter time frame. But they're still in line with the weekly moving averages. Now notice here, isn't this incredible here, how important these moving averages are for price? This used to be serving as weighted resistance. We can see that here and here. But now we're starting to see, as we've broken above the standard moving average, we're now trying to see if we can clear through the EMA, the 200 EMA here. Price is just basically bouncing in between these two ranges. The market is watching these very clearly. Now, what does this tell us about what price is doing? I think it tells us that the market is waiting for a clear sign that we are in control of inflation, and more specifically, that the Federal Reserve is ready to pivot, that it's ready to start cutting back on its hawkish nature, its increases in interest rates, quantitative tightening, and start to go towards the opposite direction, easing monetary policy by slowing down the growth rate of interest rates, starting to stop the efforts of quantitative tightening and maybe just keep the balance sheet neutral, the kind of things that would boost assets values like Bitcoin. And I think that is what the market is waiting for here. The market, especially Bitcoin for that matter, which really has had its show stolen by the performance in Ethereum with the excitement around the merge, right? I think that it needs that confidence from the Fed that inflation is tamed before it can really make a substantial move higher. Now, I'm not saying we're going to have to wait all the way until September. We're probably going to get hints ahead of time in the market, and we'll talk about some of those that you can start to see in price as to whether or not the Federal Reserve is going to be able to confidently pivot, as so many people are starting to bet now during this rally we've been seeing that will either confirm whether or not we're in a official bull market or just a bear market rally. We feel we're on the latter of the two. We feel this is a bear market relief rally, and I'm going to talk a little bit about that as we go throughout the data here. So again, one last thing I want to talk about here in regards to crypto before we dive into taking a look at equities and then talking about our macro charts that are going to help to understand whether or not Bitcoin, Ethereum, and the stock market are going to start moving higher. I want to take a look at Ethereum here. Ethereum hit our target. We had a target range around 0.77 to 0.78 here. This was generally where we had been calling for Ethereum to move since back here in July. And now it's starting to look a little bit exhausted over our level that we called for. It even moved a little bit higher here. And now it looks like it's quite exhausted here. If you just take a look at the past few months, guys, this is how typical rallies or bump ups here in the E to BTC ratio play out. We can see we had a very similar move here from around this support range where buyers really started to come in like we did back in June of 2021. And this was a resistance range back in the past. And we can start to see that after a couple days of sideways price action or a little rollover here in price, we can really start to reverse the trend here. I got to tell you all, I understand a lot of people are excited about the merge. People are walking real confident into it. And while there is definitely the opportunity for Ethereum to take market share, as it already has been doing, back from all these alternative layer 1 protocols that did really well during the bull market, this is pretty typical here when you're in a bear market for dominance from the more high risk, high speculation, and high reward plays to come back into the safer plays. And the merge, this network upgrade for Ethereum, is just further solidifying that. It has to do with the fact that if Ethereum is able to move to proof of stake, this is probably one of the biggest transition steps for Ethereum throughout the entire steps of the merge. Essentially, this is going to solidify Ethereum's position long term to be able to be one of the dominant layer 1 plays. And unless a blockchain comes up with a radical different approach, I think networks like, for example, like Kava or Radix that we watch here in the channel, they are not going to survive very long, especially considering a lot of the technical issues with networks like Solana, etc. But anyways, my main point here is this, is that there's a lot of reasons why this has been so exacerbated, but it is important not to get caught in the FOMO here. The time to get bullish was when everyone was fearful in the market. And typical bear market rallies, they will trap you. They will get you into this emotional FOMO that will lead you buying in yet again at a higher price and taking losses as price goes down, either forcing yourself out of your position or being left with a bag for a long period of time. Now, I want to go ahead and talk a little bit about equities here. Equities are in the same boat here. Take a look at the RSI here, right? The RSI isn't an absolute indicator. It doesn't mean when it goes into overbought territory, you sell everything. But I do want to talk about here just how overbought we are looking in a bear market, what is likely a bear market rally, okay? Now, again, I know some of you will disagree here with me as to whether or not this is a bear market rally. Either way, even if this is the bottom of the market back here in June, and we are going to break through here, we do not want to get overtly confident until two things happen. Until price gives us the confirmation it's really over, and the second step is the Fed pivot. Now, I know a lot of people are betting on the Federal Reserve pivoting here, but until this week, until we get some comments from some of the members of the Federal Reserve, we can't be so certain about that. The FOMC meeting isn't going to be until September. And to be honest with you all, the Federal Reserve has made it very clear that inflation and cooling inflation is its number one priority, not inflating asset markets, right? Jay Powell was very clear in the past meeting back in July that that is going to be priority number one. Now, on top of that, back to point one here, we've got price action we need to see. We are in the exact same range where equities topped back in last March, right? Back in March of 2022, going into the early part of April. The NASDAQ had a significant bear market rally here from March 15th in about 10 trading days, up nearly 18% into the close of the month, hitting that 200-day moving average. So we're just looking at the standard daily moving averages here. But this is where price each and every time started to get overbought and roll back down to new lows. And that is what we have to assume here until we can hold within this range and have a solidified breakout to the upside. Maybe, and again, this is the argument for the bulls here, if all of the different charts that we're going to talk about earlier can give the positive signs to the Fed to pivot, that could very well be the sign for the Federal Reserve to make a very clear statement in September that they are pivoting. And by that time, if we take a look at the chart here, perhaps maybe equities hold within this range, they get above the 200-day moving average as we talked about before and are able to turn that into support and set the foundation, right, the breakout point for us to move higher here and confirm the end of the bear market. The Fed maybe at that point has a control on inflation. But I got to be honest with you all, while that is what the sentiment feels is going to happen right now, the general market, it is not likely whatsoever right now. It is still the unlikely play here. And the reason why is because we have not seen sustained downward moves in the inflation in the economy. We saw this past month, we had a lower print, and that's been mainly driven by one of the charts we'll take a look at in a little bit. But we need to see sustained moves lower. The Federal Reserve is not going to do anything irrational here at these levels. They've made that very clear since back in July, okay? We can take a look here at the S&P 500 here, right? Similar situation to the NASDAQ, coming back into this pocket here between the 200-day EMA and the 200-day moving average, even more overbought here than the NASDAQ. That's a very important sign to focus on here. We are already in overbought territory. This has not happened all throughout the bear market here. So keep that in mind as we've moved higher here. We've had a pretty substantial rally off of the lows. We've come up about 17.8%. Again, not the kind of period of time until we get further price confirmation to get risky at these levels. It's the same with Bitcoin here, not to go all in here, or Ethereum after prices, in the case of Ethereum, have almost actually more than doubled off of the lows, right? This is, again, the common trap that people get caught in. Okay, so now we've talked a little bit about equity charts. We've talked about the crypto markets. Let's go ahead and talk about the 5 charts everyone should be keeping on the radar. There's actually going to be potentially 6 to 7, but I want to go ahead and talk about the core kind of sectors or major metrics we should be keeping an eye on. And I think these are going to help serve as a point system. With each chart that is starting to signal either bullish or bearish momentum, we can start to determine what the Fed is likely to do into September, because these are things that the Federal Reserve is watching alongside its economic market indicators, right? Whether or not this is exactly what people would agree with or not, these are the kind of signs we're going to see whether or not inflation is under control. And they can give us hints to what the CPI is going to be and what the economy is going to be going through, okay? So let's go ahead and dive into the first one here. The first one is the VIX. Now, the VIX right now is at a practically low level here. It's back here where it was in April of 2022, March of 2022, right? Basically during the last relief rally. We can see back here during March in this time, whether you're looking at the S&P 500 or the NASDAQ, things were looking good. People thought that the bear market was over. It was time to return back to normal. Everyone was excited. Well, let's go ahead and again expand our time frame here for the VIX, right? We've seen that we've come through this range time and time again. Essentially speaking, when we get in down to this range, this is usually a cause for concern. It's not a time to get optimistic. We want to buy when volatility is high, when fear is riding high, when we're getting discounts in the market. When other people are not willing to take risk, we need to be willing to take risk. And when the market is excessively risk-taking and excessively optimistic, that's when we start to take profit or step away from the table. I want to take a look here at the weekly VIX moving averages here on the weekly time frame, right? So each of these candles represents a week worth of movement in the stock market and the volatility therein for that week for the S&P 500 and the options market. Now, really interesting telltale sign here is that for the majority of the time back in 2021, when things were really riding high here, we were at the peak euphoria of the bull market, everything was going great, everyone was a winner. You can see that the VIX maintained most of its price history, albeit with a few spikes along the way, mainly stayed below these moving averages here. I'm going to go ahead, I'm going to hide price here for a moment so you guys can essentially, yes, I can't do that. We'll go ahead and keep that. I'm just trying to kind of showcase here. You can see the moving averages driving through here, and we can see that price is hanging below those moving averages here. But throughout most of the bear market here, we've been generally hanging above these moving averages on the weekly time frame, right? So until we can showcase the signs here that we're ready to come back down into this range again, right? The low volatility we usually find during bull markets, right? Where most of the time is below these moving averages. Until then, we can't be too confident here about what price is going to do to the upside, right? Essentially meaning that we can't expect the price is just going to rebound higher here. In fact, we should be cautious, as we have for the past few times, when we step into this range, that volatility could spike up again, meaning that equities could decline around this range or at least face some chop until we get further confirmation, right? Until the VIX can actually sustain below these levels and start treating these moving averages as resistance. This is a generally bearish indicator here. The fact that volatility is low in this environment and we have not sustained long enough in a low volatility environment, this is a cause for concern here. So this is one point to the bears here. And again, one of the biggest solidified reasons, according to history, why we should not be getting excessive with our risk taking at these levels. So take a look at the Dixie here. Another point for the bears. Over the past 3 trading days, we've gone from around 104 on the dollar index up towards around 106. If you just take a look at the hourly here, bulls are taking confidence back. We've had a clear double bottom here on the hourly time frame, and bulls are driving valuations back higher here. If we're able to have a solidified close above the 106 to 107.5 range, this is pretty much your telltale sign that the bulls are back in charge here. And a stronger dollar, ironically enough, is not a good sign for the Fed. The Federal Reserve, if it has a cool down on inflation, not just for the dollar, but for global inflation and global demand, you essentially would want to have a weaker dollar. The Fed does not want a stronger dollar right now because they need to make sure that other central banks across the world are able to keep up against the value of the dollar to mediate inflation. Because when the dollar is garnering strength and it's going up, and if there's inflation in the United States economy, it is going to be worse across the world. And that means the Federal Reserve has not been able to bring back equilibrium between demand and supply. It has not been able to bring supply of commodities and goods and services back to the demand that there is currently in the economy. So right now, so long as this is trending higher here and getting out of this pocket here that we've had drawn in our chart, this is again favoring the bears here. Another reason to be a bit fearful here. Third chart here that favors the bears, unfortunately, is the US 30-year yield. The bond market, right, the yields that you get on treasury notes are going to tell a lot about whether or not the stock market is picking up what the Fed is really putting down. Essentially, it is going to tell us a much more clear picture of what the Fed is really going to do when it comes to interest rates. Because if the federal funds rate is going up, or the market is pricing in that the federal funds rate is going to continue moving higher, bond yields should move higher. And vice versa. If the markets are estimating that the Federal Reserve is going to start to slow down its quantitative tightening and start to lower the growth rate of interest rates and maybe even start taking them a notch down, right, you would expect bond yields to start dropping. So this, again, is showcasing another sign here that the Federal Reserve has not officially pivoted. It is still back where it was throughout the mid part of July here, and it is still pricing another couple of basis point increases here in the same range that the Fed has typically done in the past. So we are not seeing any major decline here. We're not seeing the move lower just yet. I would expect if we come up into this range, there is a chance if you start to see us get back up here that we might have a head and shoulders pattern going into September if we get more comments from the Fed and we start to see a drag down here towards 2.6%. Perhaps that could be your top signal here. And again, that's why we talk about not trying to rush into a lot of this euphoria until we're able, through equity valuations, to push sideways for a while and make these moving averages that we're acting as topping signals or resistance into new support. So again, big point here again, while it is in favor of the bears right now, it could start to shift over time. And until we get more of these signs favoring the bulls, we shouldn't get too optimistic. Now, the next set of charts that I want to take a look at here are energy-based commodities, oil and natural gas. While I will say that oil is definitely favoring the bulls here, right? We can clearly see that we're having lower highs, lower lows. The RSI here, again, is not showing the same kind of upward trend here. It hasn't gotten to oversold levels just yet, as I think many people are estimating that we might come down here into this $80 range before we see a temporary bottom in oil, right? Even though we haven't seen that yet, right, we are seeing that the bulls are favored here. Natural gas, another important commodity, probably just as important here as it has to do with the energy bills that people are paying here and a lot of the geopolitical tensions in Europe. It is not letting up here. This is the monthly chart here for natural gas. So I'll take it here to the daily. You guys can see what I mean here. Very different in stark trend against what we're seeing in oil. Oil is clearly in a downtrend here for the time being. If you take a look at the monthly time frame, we can see that oil looks overbought and is looking to enter in towards more downside price action until it can find some range and base of support here, potentially around $80, which was previous resistance roughly in the past, $85. And if we take a look at natural gas, on the other hand, on that monthly chart, I got to tell you all, having a down month like this of 33% made up and engulfed within the next month, up 50%, and still continuing to hold in that upper band here, this tells me that natural gas essentially wants more, that the market does not think that natural gas supply and demand is going to be brought back to equilibrium, that demand is too high, the supply is dried up, and that prices are likely going to move higher here. Got to be honest. And that's why for commodity-based inflation, I have to keep it neutral here. I would not give it to the bulls yet. We can see that oil is definitely leading down here. Great sign here. But natural gas is the other key factor here. Until we get another red month down here to confirm that this is ready to move lower, can't be confident on it. Next up is industrial commodities here. What's going on? So we've got the lumber futures here. All right, this is the one I really want to focus on here because this has a lot to do with giving us a gauge on the housing market. And although lumber prices don't make up a huge part of the cost of a home, what this does signify is new building permits. This helps to play a role in understanding whether or not home builders are looking to step back in and continue meeting to the demand in the market. Now, this overall has probably been one of the biggest bullish factors here for the market. The reason why is because as lumber prices are starting to come down here, this is essentially meaning there is a cool down in the housing market, that demand has really started to slow down, that the existing supply on the market is getting to much higher levels. And you can already see this through a lot of the market information that we have available to us on tradingeconomics.com. You guys can look up the amount of housing inventory, or the amount of supply that is readily available for home buyers. And because of mortgage rates being as high as they are, this has led lumber prices to drop down dramatically as new building permits have started to slow down. Now, again, we have seen buyers come here. We saw a pretty big whipsaw here of 22% over the past week here at a range that has been historically previous resistance. So again, this could flip in favor of the bears here, right? Because if this starts to move higher here, we can start to see that demand isn't cooling in the economy. I know it's a bit of a mind trick here, but follow me on this. If lumber prices are moving higher, this means that home builders are coming back into the scene. This means that the demand on the market is hot and it is coming back, and that the Federal Reserve has not been able to cool that demand in the economy. And if they haven't cooled that demand, that means inflation's moving up. And if inflation's moving up, that means the Federal Reserve cannot pivot. So again, key point here, right? This is in favor of the bulls so far. I'm going to go ahead and give that to the bulls here. But if we take a look back at our conversation here from the VIX, from the dollar index, from the US 30-year yield, to oil and natural gas and to lumber, we can see right now that the bears, whether fortunately or unfortunately, depending on how you're positioned, the bears are in the lead right now. We need to consider that when we're making our macro analysis here. And until we start to see more of these charts favoring the bulls, we need to be cautious at these levels, right? And even if these charts don't start favoring the bulls, what we need to at least watch for, if you take anything away from this video, is wait to see if this range can actually be turned into new support here and can start to serve as a new higher foundation of price in order to move higher, rather than a sign that prices are ready to move lower once again. And it won't happen overnight. It will probably take some time here, and that's why we have to be patient. But if you guys want to know what we've been doing here, we've been taking profits up along the way, reducing losses in some positions, still locking in some great profits from the previous bull market that we were in, and overall looking for that next solid entry point. So if you guys are interested to learn more about how I'm entering and exiting the market, if you guys have found yourself all the way at the end of this video, first off, give yourself a thumbs up. But on top of that, if you guys are interested in the kind of content you see here on the channel and you want to learn more, definitely consider subscribing to the Dash Report down below in the description. It's a newsletter we do. We cover crypto, equity markets, Forex, commodities, the whole shebang, even deeper than what we do here on the channel. And you guys can get 20% off if you subscribe on an annualized basis. But if you did make it this far in the video, there is one other thing I want to share with you guys. If you haven't heard about it yet, I signed on with an exclusive content platform known as Rockfin. And we're doing a really cool series called The Diaries of DataDash. For those of you who have wanted to get to know me more personally over the past few years, or learn about my 10-year plus journey in investing and trading, definitely check out the series. It's only $9.99 a month to get onto Rockfin. And you guys can even watch the trailer if you guys want to get a feel as to whether or not you'd want to subscribe. There's tons of other content creators you get access to as well. It's not just for me when you subscribe to Rockfin, but definitely check out that down below in the description. I'll have a link for it. That being realized, everyone, thank you so much for giving me some time out of your day. Always love getting to ramble here. If you enjoyed the video, drop a like. And until the next one, I'll see you all in the next video. Take care, everyone.